Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt. Where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, help to make it actionable, understandable, and clear. Hope you're staying dry if you're a Dallas side. Lots of rain. Good news is not a lot of fees for my low-cost kings and queens out there. If you're an indexer, excellent lineup. The producers, the editors, they come together sometimes and put forth a wonderful lineup. We're talking Vanguard. I had friends of the show reach out this week because Vanguard hit the podcast circuit. I guess there was a podcast called Acquired, famous podcast, and Vanguard was on it. So we're going to talk about a Wall Street Journal article that discusses that podcast. We then look at Mr. Jason Zweig, one of our favorites. One of our favorites is a bubble. It's starting to get soapy. And because it's Zweig, who we trust implicitly, it's worth reading. And then in closing, we're going to talk about bonds. This is something no one wants to talk about. Bonds, fixed income, why you do it, why you don't, what's confusing about it. Let's start at the top. Headline. This is an article by Ben Gilbert and David Rosenthal. Headline, Vanguard is the Costco of finance, according to the host of Acquired. Subheadline, the financial behemoth was set up to offer lower fees, and as it grew, its approach has driven other fund firms to cut their fees. A little history lesson here. Did you know, listener, that in 1975, that's not that long ago, guys. 1975 wasn't that long ago. Index funds owned 0% of the stock market. Index funds, in their totality, owned 0% in 1975. Do you know what it is today? And I'm talking to everybody. I'm talking BlackRock, State Street, Fidelity, Vanguard. Together, what do they own? 24% of the entire U.S. stock market's owned by index funds. It was 0 in 75. That's a doozy. Vanguard, this article explains, has about $10 trillion with a T in passive index assets. It is the single largest owner of the majority of corporations in the S&P 500. Yowzas. That's big time. Now, what Vanguard does, and if this is your first time listening to the podcast, we're so glad you're here. I feel like a pastor who welcomes the parishioner into the pew. If you're here for the first time, we're so glad you're here. We want you to know more about Vanguard. Vanguard has a unique corporate structure. So the reason why they analogize it with Costco is if you've gone into Costco and you know how their model works, and I actually went back and looked at Costco's financials to confirm this, not this week, but in previous weeks, Costco does not make money selling you a product. When you buy a big old thing of paper towels or toilet paper from Costco, it's a break-even business for them. They make money on their membership. So it's super straightforward. You pay whatever you pay, $150, $80, depending on the level of membership you want. And once you're inside that Costco, it's an at-cost relationship. The peanut butter, the four they're going to make you buy, at cost. Costco breaks even in totality on all their products. So it's a high-trust environment if you're comfortable knowing that they only profit from these annual fees, membership fees. Well, Vanguard takes it a step further. Vanguard doesn't have any shareholders. Costco does. Costco is a publicly traded corporation that is beholden to the shareholders who own it. Vanguard is a mutual fund company. Who are the shareholders at Vanguard? This is a mind meld. You have to stay with me now. I want you to bring in the grandchildren on this one. Even the dog. Vanguard is owned by the actual mutual funds. The actual Vanguard mutual funds own it. It's a mutual fund company. So what happens as Vanguard scales? There are no shareholders. Fidelity's got the Johnson family. Charles Schwab's got public shareholders. No one's jingling the chain saying, hey, distributions, profits, dividends, pay me. Nobody. It's just the mutual funds own the company. Therefore, what's in the best interest of these funds? It's lower fees. So the larger Vanguard gets on their way to 10 trillion, and this was fascinating. I didn't know this. On the way to 10 trillion, do you know how many times they've cut fees since 1975? Go ahead and guess. I want to hear it. How many times? And think about any other company who would even have a chance at matching this record. How many times has Vanguard cut fees since 1975? 2,000, over 2,000 times. And they've gone from an average firm-wide management fee of 0.68, which, can you imagine that? In 1975, it was a firm-wide management fee of 0.68. By the way, that is high today. I don't care who you are. Even JP Morgan would blush if they tried to roll out an index fund at 0.68%. Even an active fund, they do it. They do it. But nowadays, it's like walking outside without adequate clothing, having that kind of a fee on a mutual fund. Today, 0.06% is the firm-wide management fee. Wow. Isn't that incredible? And check this out. This article highlights this. Vanguard has saved investors more than $500 billion in fees over the 5 decades since its founding. I'm going to say it again. Vanguard has saved investors more than $500 billion with a B. Okay? And that if that would be the largest donation in human history. This money is going back into people's pockets, not Bogle was always good about saying, out of the casino. The money's not going to the casino, which is how he talked about other mutual fund companies. It's just a big old casino. They're taking a cut off the top. Vanguard, not doing it. Not doing it. So, and then what's also not being accounted for here is Vanguard forced other companies, Schwab, Fidelity, others, they call it the Vanguard effect, to lower their prices. So think about the savings in excess of that $500 billion from other companies being forced to match Vanguard's low fees. It's an incredible story. And by the way, I recognize I haven't camped out on the biographical sketch that this article does, but it talks about just how difficult it was for Bogle. Jack Bogle, boy, he got basically kicked out of his firm. And in fact, it was him getting ousted that helped birth the Vanguard group, because his partners basically said, "You're out." Okay. Well, what could he do? This was basically the only thing he could do. He had this idea. There was a Nobel Prize winning economist, Paul Samuelson. He had just published an article in the Journal of Portfolio Management in which he described the futility of trying to find active stock pickers. His idea was, hey, someone should just set up a fund to track the S&P 500. If it kept its fees low, it would outperform a lot of people. Yeah. And Bogle ran the numbers. In 7 of the prior 11 years, if you had owned the whole S&P 500 with no fees, you would have beaten half of active managers. Over the full decade from 1964 to 1974, you would have outperformed 78% of them. So this was Bogle's big aha moment, and he did it. He decided, I'm going to try this. I'm going to open this shop. For legal reasons, he wasn't able to do anything other than this. And look at what has blossomed as a result. There's alignment between shareholder and customer in a way that just doesn't exist in other companies. This article explains there was no financial incentive for Bogle to create this company in the first place, because it exists solely because he decided to basically let these funds own it. And Bogle, they put him on I watched an interview with him, and they said, now, this is when he was well along in years, but Vanguard was big, big, big. Not as big as it is today, but trillions of dollars, maybe $1 or $2 trillion. They said, now, Mr. Bogle, do you ever regret or wish that you could have owned it yourself? Because he could have, and he would have been worth billions and billions of dollars. And they analogize, you could be like the Johnson family of Fidelity. And Bogle was so candid. He said, occasionally I have that thought, but I don't. He wouldn't let his mind go there for long. And he talked about just how much he benefited on the personal side from being able to invest in index funds. He had a employer account and a 401k type vehicle, and he would just invest. And he talked about just, can you imagine? He started doing this in 76. Just steady as she goes, index funds. And he said that was great. That was plenty. Bogle, he went to Princeton. Part of his thesis was something akin to what he started with Vanguard, but he was able to do a lot of very generous things to Princeton. I know we've got some listeners that attended Princeton. And I believe he was giving away half his income at the end of his life, Jack Bogle. So anyway, we have much to be thankful for. As you're aware, Bogle's influence is strong at Vanguard, but we can't just walk in there with our eyes closed. They do have a lot more products now. So we got to be sharp. Wise as serpents, innocent as doves, trust but verify. And then, is AI a bubble? Doubtless you've heard it said that AI is a bubble. So this article, this is by Jason Zweig, one of our favorites. Is AI a bubble? It's starting to get soapy. Ha ha. So Zweig just starts saying, he's analogizing to the late 90s. Now, for my listeners that won't run around the late 90s, what was happening is if you added internet to any company or .com, you turned your company to .com, there was a big boost in your stock price and people were just throwing money at anything internet because the mania was going crazy. So Zweig highlights a company I was not familiar with, AI Holdings. Started trading on the NASDAQ. And yes, the ticker symbol is AI. The company calls itself AI Squared. So what did it do? It lost, the financials, it lost $160 million on $272 million in revenue last year, but it's got a stock market value in excess of $1 billion. Okay. And what's Zweig saying? He's saying, this doesn't, this reminds him a little bit of the internet mania. He talks just briefly about, is it more to come? Are you going to put AI? Because back then he was saying you could throw internet on a ketchup company and it'd go up. He's saying, will there be AI-enabled ketchup bottles? And he says this AI-integrated underwear, a bit bizarre, but that's what Zweig says. And are we in a bubble? Are we in a bubble? So he has this great comment where he actually in the late 90s said we were. He put out an article saying, you know what? This is a total bubble. And he said he got more hate mail, people calling him all sorts of nasty names, vitriol, bitterness, anger. Oh, he said it was just terrible. And you know what? He then did a follow-up from his last AI article where he talks about this. He said, no, we're in a debating phase, he says. So he says maybe we're not in that big of a bubble because people were just, just debating him. They weren't just incredibly angry that he would bring it up like they were in the late 90s with the internet bubble. So his comment was, maybe not. That's why he calls it getting soapy. But I thought it was a helpful article to help us remember, financial history doesn't repeat, but it rhymes. And the day may come when even on this podcast, I say something like, feels like a bubble. And that might encourage some market timers amongst us to do things they shouldn't, which is why I typically steer away from that commentary. But of course that could happen. It could happen. I am a strong proponent of head down, ears covered, eyes closed, one step at a time. Don't worry about valuation. Every man has its limits. So that game, I confess, it gets harder when things are just bananas. Like the late 90s, it would have been harder. I still would go through with it. I so distrust myself and my ability to market time, and I distrust the practitioners and the high priest of finance to tell me what to do, that even if it was just tulip mania, I'm buying tulips at the prevailing price. Maybe I'm a Luddite. Maybe I'm a lemming. Lemming's probably a better word. I'm just falling over the cliff. But my experience has been, it is the lemmings who do well in investing, not the savvy folks that can go in and out of the market at the right time. No, those folks underperform almost always. Occasionally you'll meet someone who timed it right. Here's the real problem. One of the worst things that can happen to a man is he puts his money into cash right before the market crashes and buys back in at the perfect time. Oh, it's the worst. It's the worst thing. So you know what happens to him? He thinks he's got it. He thinks he's got the Midas touch. He can time it. And wouldn't you know it, everywhere he looks, he sees a bubble. And for the rest of his life, unless he becomes humbled, he's always picking tops and picking bottoms, or trying to. And it's a waterless spring. It's a mirage in the desert. It's ultimately a fool's errand. But boy, one of the best things that can happen, before I work with clients, I have them give me their financial testimony. Oh, I love hearing in these financial testimonies, you know what, I tried this and it failed. I tried to either do stock picking or day trading or market timing and it failed. And they usually, the client usually thinks they're kind of in this confessional where I'm just going to hammer them for that. And I'm usually just absolutely delighted to hear they learned that lesson. What is much scarier is when someone tells me, called the late 90s, called 08, called all these things, picked the bottom, picked the top, picked the right stock. Oh, you're in for it. It's going to be a long road for you as an investor. So, of course, I don't want people to lose money, but if you are thinking about teaching your kids how to invest or equipping them how to invest, I don't know of a better teacher than the market itself. You can tell someone what to do, how to do it, what the numbers say, what the academics say, what the speed report says. I can show them 50 charts until they have the visceral gut feeling of losing money, doing bad things. I don't know what a better teacher is than the market. Can't think of a better one. And in closing, bonds. Who wants to talk about bonds? No one wants to talk about bonds. There's probably a bond podcast out there that's awesome, but I bet it's hard to get people to listen because it just doesn't move as fast as stocks. But I want to talk about bonds. How and why you should have an allocation of them, probably. In most instances, I recommend some sort of a bond. What's a bond? A bond allocation. A bond is a promise. You've heard maybe of U.S. Treasury bonds, U.S. Treasury notes, U.S. Treasury bills. Those are a different way of saying, hey, the 30-year, or 10-year, or 2-year. There are different durations of these bonds, but different than a stock. Remember, a stock is a ownership slice of a company that, hey, maybe you lose money, maybe you make money over the long pull, maybe they pay you a dividend, maybe they don't. Maybe the company goes to zero. It's not a promise. The company doesn't have to pay you anything. A bond is a promise. It's a promise. And most people need some sort of fixed income exposure. Not all. There are exceptions everywhere, but most people. The reason being, it is my belief that when financial calamity strikes and the market drops precipitously, we are less resilient than we think. We are not as tough as we think. What bonds offer, that promise, is a ballast, a shelter. It could be a 10-year storm. It could be a 20-year storm, guys. No rule against it. And if you don't either have a lot of cash or bonds or the ability to not need your stocks at all ever, I think you're cruising for a bruising. And in my view, the best way to allocate there is just an index fund. I like ticker symbol BND. It's Vanguard's bond fund with various durations. Durations meaning how long those promises are staggered out on the bonds. And this fund moves. Okay, this fund, interest rates go up. Oh, fund value will go down. But some allocation is important. And I recommend the index fund, not trying to pick individual bonds. There's a whole host of reasons there, but keep it simple. Keep it simple. Because that's what we're doing here at the Robert Hunt Financial Market Update. We're keeping our cost low, investing simple and time horizon long, because that is what's going to give you the best shot on your investing journey. Until next time.